Hey there, Dave Keller here with Market Misbehavior. I'm asked a lot about moving averages in the course of my work. A lot of people want to know what moving averages people use and why. And sometimes I'll get questions about what are called exponential moving averages. Most of the time when you look at a chart and you have the 200-day moving average, it's a simple moving average. But there are other ways that you can smooth out price movements. And one in particular is arguably a better way of measuring trend. It's called the exponential moving averages. What we'll do today is talk about exponential moving averages, how they differ from a traditional simple moving average. And I'll share with you my market trend model, which I also get a lot of questions on, most of which is based on exponential moving averages. I'll explain why and share with you what it's telling you about the market right now. So today, what are exponential moving averages? So I'm often asked about moving averages, and it's a commonly used technique that technical analysts use to smooth out price movements. Markets themselves are noisy, right? The market moves up one day, down the next day, a lot of fluctuations, and regardless of what the overall trend is, you'll have little movements up and down. And the markets are noisy. You can smooth them out using moving averages, or what one friend of mine used to call a smoothing mechanism, right? A way to smooth out the price movements, get rid of some of the noise, and just look at the overall trends. Before we get to what moving averages are, particularly exponential moving averages, and why you should use them to understand the trend a little better, I wanted to remind you, if you're interested in this sort of thinking about technical analysis, behavioral finance, trend, momentum, sentiment, all of the above, I hope you'll subscribe to my channel. It'd be great to have you along this journey with me. Also, give the video a like if you appreciate it. We'd very much appreciate it back. Finally, put a comment below. What sort of moving averages do you use? What combinations do you use? The 50 and 200-day simple moving averages, the 21 and 34-week exponential moving averages. What do you use every day and why? Let's get to the charts. So, what are exponential moving averages? Well, to answer that question, I think we need to start with simple moving averages, because that's really the more basic and more straightforward of the concepts. A simple moving average is very simply a simple average of the closing prices. It's a mean, a simple mean of the last X day or X bar closing prices. Now, you can also do moving averages of highs and lows, but very few people do that. To be honest, it's usually the closing price. So here on my kind of standard default chart that you've probably seen me use on my channel very often, I use the 50-day simple moving average and the 200-day simple moving average. Now, why do I use those particular settings? Well, I spent much of my career working with money managers, institutional investors, salespeople, brokers, analysts, and 90+% of the ones that I've worked with, if they bring up a chart and they have moving averages on there, they're the 50 and 200-day moving average, because that's the default that most charting platforms use. So I have found a lot of value in looking at what I know other people are looking at, especially people running large amounts of money. So for me, the 50 and 200-day moving averages are super commonly used, and as a result, I want to be aware of them. The 50-day moving average, by the way, or the 10-week moving average, which is very similar, are used very often as pullback measurements. So in an uptrend, here's Ford going back for the last couple of years. You can see in an uptrend, more often than not, the price will come down to an ascending 50-day moving average, and that's a buyable pullback before the next leg higher. And a lot of people think of that 50-day moving average as a trailing stop, a very simple trailing stop. So as long as the price remains above there, the trend is okay. If it breaks below the 50-day, you need to question it. That's why the sort of mid-April breakdown of the 50-day moving average was a bit of a concern for Ford. Obviously, since then it's resolved to the upside just fine, but that certainly indicated more of a risk-off posturing for the stock. So, what is an exponential moving average, and how does that relate to it? Well, I have a chart here, the S&P 500, the spider's actually the SPY, and I have the blue is the 50-day simple moving average, in green is the 50-day exponential moving average. So while simple moving averages are literally a simple average, I have 50 closing prices, I add them all up and divide them by 50, so it's literally an average. But if you think about it, it's not necessarily a great way to average the pricing, because it weights yesterday and it weights 50 days ago the exact same. And arguably what's happened more recently is way more important to the trend of the stock than what happened 50 days ago. And a lot of times what happens with simple moving averages, it's not about what's happening right now, but it's about what happened 51 days ago and what's just rolling off. And a lot of times the moving average will fluctuate based on the data that's falling off the back end, not something that's being added now, if you think about it mathematically. So what an exponential moving average does, it tries to accommodate for that, and it weights the most recent observation X percent, a certain percent, and then the rest of it is a running total of the exponential of the moving average. So every day you add a new observation and you weight that a certain amount, and the rest of the weighting is the previous value. So it literally continues to compile as you add more data. So the starting point to your calculation is incredibly important. So most charting platforms go back as far as they have data for, or back many, many years, so it doesn't make a lot of difference. And then they keep calculating this exponential average every day and just keep adding the running total, and that's what gives you the average. What does this mean in practice? Well, if you look at these two lines, you can see that in a normal trend, like and the SPY sort of fourth quarter of 2019, as the market's going higher, you can see that the two moving averages are very, very similar, almost identical at times. So because the price is in a consistent uptrend, because the price continues to go higher, the averages are relatively similar. You'd make no real difference using one versus the other. But look what happens during periods of dislocation or during a distributive period here. If you look at the February 2020 market peak, when the market sold off, you can see that the green line, the exponential moving average, is way more follows the current prices, or follows the actual prices more closely. Now, nowhere near the severity of the decline, but you can see that it goes off a lot more suddenly because it's more weighted to the current price action. So as the price sells off, it drags the exponential average much more quickly. The simple moving average kind of slowly and sluggishly comes over. Then when the stock, or when the S&P bottoms out and starts to rotate higher, you can see that the exponential average starts to slope higher right about here, sort of in mid to late April of 2020. The simple moving average takes all the way to late May before it actually turns positive and translates from a downward slope to an upward slope. So a lot of people think of the exponential averages as being more reactive, meaning they react more quickly to what the price is actually doing. And if you're designing a model to track price trends, arguably exponential averages by any stretch of the imagination are a way better measure of trend, just because they react to the price movements more deeply. You can also see that here in 2018 to 2019, when the S&P sells off, you can see that the exponential average follows the trend more closely and also accelerates to the downside. When the market turns back up, it more quickly slopes back upwards about a month and a half before the simple average. That's pretty standard, actually. It usually is more reactive. Now, a lot of technical indicators, by the way, are calculated using exponential averages. So RSI, which is one of the most commonly used technical indicators, is based on an exponential average of up and down days, or keeps a running total and creates an exponential average. Also, the MACD indicator, the moving average convergence divergence indicator, which is essentially based on the difference between two exponential moving averages. Here's the weekly MACD, or what I'm calling here the weekly PPO, which stands for percent price oscillator, very much like the MACD indicator, if you've heard of it, but smooths out, it uses percent changes instead of actual dollar amounts. So it's a little easier to make apples to apples comparisons across different charts or different asset classes, but the signals are almost identical between the two. So this weekly MACD, or weekly PPO, the green line here is the difference between the 12 and 26 bar exponential moving averages. And then the red line, called the signal line, is a 9-bar moving average of the PPO line, or of the MACD line. And so this is an indicator based purely on exponential averages. What we're looking at here, by the way, is what I call my market trend model. This is something I created years ago and have been following pretty consistently. I update it every Friday after the close based on the weekly close of the S&P, and I run on a number of other asset classes for my subscribers as well, and focus on what those signals are telling us. What I wanted to do is just walk through these three, because they're all based on exponential averages. In the top, I have most of the averages that I'm using. In green, we have the 5-week exponential moving average. In blue, the 21-week, and then in red, the 34-week exponential moving average. We'll get back to the green one in a second, but the first two are the 21 and 34. If you know your Fibonacci sequence, you know that those two are Fibonacci numbers, and that is honestly how I came up with that combination. I tested a bunch of different ones, and for me, what I was trying to do was find a market trend model that would track the secular trends. I wanted something that would remain bullish when the market was long-term in a bullish trend, and would turn bearish only after the secular trend had reversed. So really only turned negative in like 2001, 2002, 2008, 2009, those periods when it was a real secular decline in stocks that I wanted to capture. And so by using those two, the 21 and 34, it creates this purple histogram, which is simply the difference between the 21 and 34 week exponential averages. So if this is above zero, the 21 is above the 34. If it's below zero, the 21 is below the 34. So for me, I'm simply looking at when this crosses up or down through the zero line. If it's above the zero line, which it has been since June of 2020, overall, the secular trend is bullish. It turned negative, by the way, in mid-March of 2020 when the S&P was selling off. S&P bottomed out, took a couple months for the model to sort of acknowledge the reversal to the upside, finally did in early to mid-June of 2020 and has remained fairly bullish since then. So overall, that is showing you the secular trend is positive, which with the market at or near all-time highs is absolutely where it should be. The medium-term model for me is based on the traditional weekly MACD. These are probably the default settings on a MACD indicator. If you brought it up on any charting platform, it's going to look kind of like this if you look at weekly data on the S&P, and it's based on that exact information. It's the 12 minus the 26-week exponential averages. That's the green line here. And what I'm simply looking at is when this model crosses up or down. When is it giving a buy signal means the green line is crossing up through the red signal line. It gives a sell signal when it crosses down through one another. And it's literally showing you the change in those moving averages and the shape of those moving averages over time. What's interesting is it actually turned bullish a little earlier than the long-term model. Turned bullish there in May of 2020 after the S&P was coming out of that April pullback and continued higher. You can see it gave a couple head fakes here in October of 2020 before turning positive in November, then again in February 2021 before turning positive in March. And I don't have a problem with that. That was during these sort of cyclical corrective pattern here. This is the sideways consolidation period in September and October of last year before it broke out to the upside. And then the last time it gave a sell signal was here in mid to late February, which looks just like a normal price here. But on the daily chart, you can see obviously it was a pretty decent pullback there, and it felt like it could start to be a little more significant. Price got below the 50-day moving average, simple moving average on the daily chart. But then, as you know, it resolved back to the upside, broke out to the positive side. So in both cases, a couple weeks later, it gave a buy signal indicating that the medium-term trend was back positive. It actually just recently in mid-May gave another sell signal. So what that is, you can see the very simple color coding I'm giving it here. The long-term bullish, the medium-term remaining bearish. And I'll come back to in a little bit and tell you what that means for my own process. Finally, I have a short-term model, and that's literally just where the price is relative to the 5-week exponential moving average. Now, when I'm looking at the tactical time frame like that, I usually look at the daily chart because I think it gives you a lot more granularity about supply and demand and key price levels. But for me, I just like having a placeholder on the weekly chart, just a quick measure of the short-term trend. So if this is above zero, the price is above its 5-week exponential average. If it's below zero, it's below its 5-week exponential average. Just gives you a very quick read on whether the short-term movements are positive or negative. So as of last Friday, which would be early June of 2021, the long-term model remains bullish. The medium-term model has turned bearish a couple weeks ago. The short-term model remains bullish. And to be honest with you, that actually is how the market seems to me right now. The long-term trend is undeniably positive. We are at or near new all-time highs in most markets. That's about right. The medium-term model, to me, though, the market feels extended. I'm seeing plenty of stocks breaking out like Facebook and Microsoft, but I'm seeing plenty of stocks not breaking out like Amazon and Apple and Tesla and the ARK Innovation Fund and others. So it's not like everything's going up. It's a dispersion, right? There's a differentiation between some things working and some things not. So the medium-term model turning negative, I think, sort of recognizes the fact that the S&P hit a high in April and has been unable now for the last 6 or 7 weeks to break above that level. That's about right. I think that's about how the market would feel. So it's not saying we're going down a lot. It's just at this point indicating we're not going up. And the short-term model has remained positive, which is about right. We keep popping to the upside, and at some point that will turn negative when we get a bit of a distribution phase. We really haven't seen that in quite a while. So what does it mean for me that the medium-term model is negative? Well, for me, the medium-term model is my general risk-on or risk-off indication for equities. I was taught early on that a rising tide lifts all boats. So, in general, you want to be buying stocks when the overall market is in a positive phase. You want to be lightening up or going to cash or being defensive when the market's coming down. If you can understand that big picture and the fact that most stocks follow the broader market, overall, you're going to be on the right side of things, and you're going to be looking for opportunities when the broad market conditions suggest so, and you'll be getting more defensive and more cautious and more risk aware when the market is indicating that that's the proper course of action. It's interesting for me, though, models are not an output of my process. I would never run anything or any process or any fund based purely on a model like this. For me, models are an input. I like having a model running in the background that is very systematic, that I don't second guess. I just run this every Friday and I say, is the long-term, medium-term, short-term, bullish or bearish, thumbs up or thumbs down? And then I use that along with a lot of other things that I'm looking at, some more subjective, some other quantitative methods, breadth and sentiment, all of that. But the model is part of what feeds into that process. It's a valuable input into that process. And the medium-term model for me is the very systematic way of saying, should I be looking for new long ideas or not? Should I be thinking more about looking for the next upside opportunity, or should I be thinking more about getting defensive and being cautious and taking profits when the chart indicates it, and looking for breakdown? Am I on breakdown alert on stocks? And so the fact that the model has turned negative a couple of weeks ago for me has meant thinking less about new ideas breaking out, new long ideas. Let me put some money to work. It's more about getting defensive, sort of taking a step back, looking for making sure that I have a good exit strategy, making sure that I'm recognizing when stocks are breaking down, drawing lines in the sand on charts like Tesla and others that are testing support at 500, 550, wherever, and identifying, making sure if what happened, if XYZ happens, then I'm going to take a certain course of action. So for me, exponential averages have been a really helpful way to take out the noise of market activity. This market trend model, for me, has been a valuable input in my process. And again, I would hesitate to automate things based on a model, but I like having a systematic way, a disciplined way of understanding trend and measuring trend, and then having a set of tools that I can apply after that fact, after I understand what the model is telling me, to actually put money to work or to actually make decisions for myself and others. So that's it. The main idea with this video is to show you why exponential averages are a better measure of trend than simple moving averages. We looked at a chart of the S&P, the spiders, to show how it just is a little more reactive in general. So when I went to design a market trend model years ago and was focusing on measuring trend and quantifying trend, I very quickly got away from simple averages and went to exponential averages because it's just a better way of measuring trend. It's certainly more reactive to changes in trend. My market trend model, which we spent a good amount of time on, is a way for me to, in a disciplined, systematic way, once a week, review the overall trend characteristics of the market themselves. And I run it on the S&P and some other asset classes, other cap tiers and styles as well. And it's a way for me to consistently understand the trends in the market. And then I have another whole set of tools, checklists, and analytical processes that run after that, right? Once I understand the overall trend and I confirm what I see with the broad market, depending on whether we're in bullish or bearish mode, that tells me what I should be looking for on individual stock charts, on sectors and themes and everything else. I hope this discussion about exponential moving averages has been of help to you. If you're not familiar with them, hopefully I've illustrated some of the different ways we can smooth out price and gives you some things to think about. If you appreciated this video and this thinking about investor decision making and charts and applying systematic rules to analyzing price behavior, I hope you'll subscribe to my channel. It'd be awesome to have you along this ride with us. Also, give the video a like if you appreciated it. We would absolutely appreciate it if you'd do so. Finally, put a comment below the video. What moving averages do you look at regularly? What moving average combinations do you find valuable and why? From everyone here at Market Misbehavior, I'm Dave Keller. Be well, stay safe. Talk to you again soon.